The global macro environment we find ourselves in 7 years after the bursting of the tech bubble certainly has its challenges and its opportunities. The last decade's financial market prosperity really has its roots in the dividends from persistent low inflation and the globalisation of securities, goods and capital markets. And I think it's important not to forget that the continuation or otherwise of these trends will really be what's critical to the medium-term asset market expectations we all have, and thereby to the formulation of appropriate asset allocation strategies. Now, these constructive secular supports derive from three things: the growing presence of the developing world and its symbiotic relationship with the developed regions, the credibility of developed world central banks, and technological innovation that certainly all but eliminated the inventory cycle. The resultant reduction in macroeconomic volatility that we've all seen has reduced agents' uncertainty and led investors rationally to demand a smaller risk premium for risky assets. Unfortunately, though, there is a limit beyond which risk premia can no longer be compressed, and I think markets found that limit in June this year. The catalyst, which really isn't the critical issue, but the catalyst was the collapse of the Bear Stearns hedge fund due to leverage exposure to the subprime market. Now, while it's ultimately appropriate that risk is more sustainably and differentially repriced, the path to a new equilibrium is rarely smooth for financial markets, and it certainly does have the potential to undermine real economic activity. The financial innovation bubble that operationalised the search for yield further out the risk curve via the creation of synthetic and increasingly complex securitisation structures reduced the transparency around their pricing model. The combination of this pricing uncertainty and leverage, which amplifies returns but also amplifies losses, impedes the market's ability to clear and certainly creates greater volatility than the underlying fundamentals necessarily warrant. Arguably, this does create opportunities for long-term investors to buy the liquidity premium implicit in these mispricings, provided, that is, the fundamentals do remain supportive. On that basis, I talk about 5 real things. Firstly, that global economic activity does indeed continue to expand. Now, in the near term, we're all familiar with the fact that that translates into the US avoiding a deep recession. But longer term, and more importantly, I think, it relies on the composition of developing world growth, orienting increasingly towards domestic demand rather than just the export-led model. Secondly, it relies on the fact that developed market central banks maintain their credibility in the face of the financial innovation bust. And by that I mean matching the tools at their disposal directly to the problem faced. In this regard, I actually think central banks, including our own here in Australia, have acted appropriately to date, with direct liquidity provision to maintain the functioning of the financial system. Longer term, the challenge will be to provide a suitable level of interest rates for the economic fundamentals as they develop, and I'll take you through some ways of thinking about that. Thirdly, I think it's important that the global trend towards open trade and free capital continue. Shorter term, the developed world political cycle and the US election cycle in particular might be a risk to that theme. Longer term, it certainly requires developing market policymakers to mature their financial systems. Finally, it's important from a fundamental perspective that US and Chinese productivity continue to be robust, maintaining the constructive low inflation backdrop that economic decision-making, policy-making and asset markets have certainly benefited from recently. What I'd like to try and do is just give you some sort of framework to cut through what is a lot of noise, a lot of fear and a lot of gossip about which hedge fund might go under next. The epicentre of the bubbly asset market has really been developing region scale. Developing region scale has really underpinned this relationship between developed and developing markets. Globalisation has enabled it by allowing a more equitable distribution of growth in this cycle. The IMF estimate that China plus the emerging markets and, importantly, the oil exporters now represent almost 50% of global GDP. This is changing the structure of international production and trade, the nature and direction of capital flows, the patterns of natural resource consumption, which we're all very familiar with here in Australia, and it's shifting the global distribution of power, which will be increasingly important over the next decade. Developing regions have always had the following characteristics: an imperfect link between their ability to produce income and output and their ability to generate liquid store of value financial assets. The economic consequences of those characteristics in scale are that excess saved income gets invested and recycled in developed world assets, and the Fed itself has quoted 50 to 60 basis points of the inversion in the yield curve we've seen over the last 5 to 6 years is a result of that recycling of excess savings from the developing regions into the developed region. Excess output competes with developed world output, promoting disinflationary trends, and that hasn't stopped yet. And cyclical pressures naturally gravitate to where supply is most constrained, namely developed world asset markets. And we've seen bubbles roll through housing here in Australia, the UK, the US is grappling with its bubble now, equity markets, credit markets. This is the environment we face. The financial consequences of that for financial markets are that global nominal interest rates tend to be capped because inflation is controllable. Global real rates adjust, though, to reflect surprises in real economic activity, and to date they've been positive surprises. Asset markets remain bubbly and trade at the top end of what we'd all expect to be fair value ranges. And importantly, wealth effects dominate income effects in developed economies. That means that liquidity withdrawal by the central banks to date has naturally been reactive, not preemptive, because it's much harder to manage monetary policy in an environment where wealth rather than income is driving the consumer. Overlaying this secular backdrop has been a fairly dramatic credit cycle, and it really began post the tech crisis, where debt reduction was the focus of most businesses. Reducing the debt on the balance sheet really delivered the 2000 bull market in coordination with those secular backdrop. Profits grew much faster than debt. Credit and equity markets outperformed, and that was an environment that really favoured a growth orientation in asset allocation strategies. But 2007 is all about leaving those virtuous phases of the credit cycle. The low level of interest rates for a long time has encouraged some releveraging, even in the business sector, and certainly that's accelerated by the private equity cycle. At the end of the day, one of the key distinctions between private and public ownership does tend to be a tolerance for leverage. It's appropriate through this phase that credit markets widen to price the fact that we're in the latter stages of a credit cycle and a mature phase of the business cycle. So in a world without shocks and no repercussions to the real economy, credit would underperform, equities would be volatile but likely to outperform cash. The fundamental risks that drive you into a bear market come through US recession, policy error, some significant institutional or bank bankruptcy, or at the end of the day, a resurgence in inflation. Longer term, I think the natural way out of this bubbly, codependent, developed and developing world system really is the financial development of China and the BRICS. As I said, credit markets should police this third phase of the credit cycle, and the business cycle is mature. So we have seen credit spreads and volatility measured by the VIX index on the right-hand side of this chart move back towards more normalised levels, so back towards their average over the historical period. Dislocation in the credit markets has real economy consequences in two ways. Either through the price mechanism, which I think is what's happening at the moment, you get a credit crunch. The aggregate demand impact on the economy is the impact that's working. So the price of credit adjusts up, hopefully more for less worthy borrowers and less for more worthy borrowers. It does have implications for a slowdown in economic activity, but doesn't necessarily imply recession. The second mechanism, which was in operation in the early 90s, is through the quantity mechanism, a restriction in the supply of credit at any price. Now, economies close to their financial leverage limits are always vulnerable to shocks, and there are meaningful risks associated with the potential impact on house prices generally from foreclosures at the margin. And in this chart, what you see is the red line is the proportion of banks which have tightened lending standards in the US for mortgages, and that's back to early 1990s levels. And that typically is associated with a slowdown in consumption in the green line back towards 2%. Now, this is occurring at a time when we're rotating away from the drivers of consumption being wealth effects back towards income fundamentals. And income fundamentals are improving. So from the period of the late 2005 through to current situation, you can see the blue line in this chart, which is real US household disposable income post debt servicing costs. So after you've paid for your mortgages and your credit cards, this is the real income you take home to spend on whatever you like, in my case, nice shoes. So that blue line has been increasing recently, back up towards about 3.5%. Now, what will determine the trajectory of this line and therefore consumption in the US going forward really boils down to labour market dynamics. You can see that non-farm employment in the US has been growing at a fairly constant rate, and an aggressive slowdown in employment would materially change the trajectory of that income line. The critical issue for employment is small business. Small business are the largest employers of domestic labour in the United States, and in that regard you can see banks have tightened lending standards back to average levels in the bottom left-hand quadrant for business, quite markedly less of a tightening than in the mortgage sector, and that seems to me to be appropriate. The other factor to consider, or the second risk outside of consumption, is the trajectory for investment in the US, and greater economic uncertainty and volatility may delay corporate investment decisions. Now, given that credit spreads must widen, and that they had to widen, they were very, very compressed, it is opportunistic, I guess, that that's occurring in a period where global investable capital is still very strong. At the macro level, I measure that by a combination of US short rates and foreign exchange intervention by central banks outside of the US, because at the end of the day, a lot of the developing market central banks are actually intervening to keep their currencies below where they would otherwise be, and that creates a wall of capital to be invested in assets. And you can see that's running at 18.5% per annum, well above previous crisis level periods. The second fortuitous backdrop to the unravelling in the credit markets is the fact that global growth is still quite resilient. I think the critical issue here, as everybody does, is China. Can China decouple, as the trendy phrase is, from the United States if the US slows? If the US slows, I think the answer to that is yes. China is quite resilient. It's growing through strong export and fixed asset investment. If the US, however, has a recession, I think China will slow quite dramatically as well, because it is their stated industrialisation model to grow through exports. And you can see here the contributors to growth are not really domestic. The other big economy in the region is Japan, and economic recovery there has started to broaden, and notwithstanding the unwind of the carry trade that has seen the yen appreciate recently, it still remains within the band that the Central Bank of Japan has been managing throughout this recovery process. Here I'd note that outside of the United States and perhaps even within the US, the behaviour of the currency seems to be much more important than interest rates in this cycle. In Europe, indicators are also quite strong, but I think there is a headwind from the strengthening of the euro, and that will be important to watch. The final point I'd make is just on this issue of inflation. Low inflation is quite critical to the underpinnings of the asset market environment that we've seen. And globalisation is a little bit of one of those words. It's like geopolitics. Once somebody says it, you really wish they'd leave the room. But all it means is that developed economies have been able to grow much faster without generating inflation. And you can see this is a very simple line, just shows you unemployment and inflation trade-off. And you can see that line has been flattening over the 1980s, 90s and in the 2000s. For that to continue, globalisation and openness of trade barriers and capital flows is quite critical. So I'll leave you with my favourite quote and hand over to Chris to talk about the implications of some of those things for the Australian market.
My topic, as I understood it, was to talk about the Australian economy, first of all. It always makes sense, doesn't it, to talk about the rest of the world, or at least some facets of the rest of the world before you get to Australia, because we know that, first of all, financial markets are highly correlated, and also that the economic growth cycle in Australia is highly correlated. Well, it's highly dependent upon what happens overseas. In the past 5 years, that's clearly been true. We've clearly benefited hugely from the commodity price boom. It's very hard, actually, to encapsulate that in a single chart, but there is a chart that I and every other economist I know have got a version of, which links the Australian economic growth cycle quite simply with that of the US. The yellow line is our rate of growth over the previous year, and the red line is that of the US. And first of all, you can see, if you just look at the red line, you can see just how much growth in the US has slowed. The biggest market risk facing all financial markets right now, that is that the US does slip into recession. Let me give you a couple of statistics that may worry you in that respect. Housing starts are down by 35% in this episode in the US. And if you go back and look at the last 8 occasions on which housing starts fell by 35% in the US, you find that such an event was either followed by a recession 7 times. So 7 out of 8 times that housing has fallen as much as this, there has been a subsequent recession. One other thing that I think is a little daunting, economists and analysts, and this is true both in Australia and in the United States, have never, the consensus view of economists, I should stress, have never forecast a recession before it began. We always forecast soft landings now, and that's the view now. And I agree with Alison, incidentally, that employment is the key in the US. But to get to my main topic, if you like, to get to Australia, as you can see, this chart shows there generally is a link, but I can't find a previous occasion in this chart where those two lines have been diverging at the rate that they are diverging now, with US growth clearly slowing and Australian growth accelerating. So I think it's justifiable, if you like, to say, OK, let's forget about the rest of the world for the minute and just talk about Australia. So far, the aggregate measures of wage inflation in Australia have been remarkably benign. So once again, this is inflation pressure rather than current inflation. But something has happened in the past couple of years, as you can see, that for the first time in a long, long time, when you ask firms, what's constraining their output? Usually the answer is, as you can see, well, we don't have enough sales, we don't have enough orders. But for the past 2 years, and increasingly so, firms have reported that the main constraint to further growth is the ability to attract and hold suitable labour. So it is quite clear, if you like, we are running out of room in the labour market. So far as I've suggested, however, wage inflation has been remarkably modest. This is the wage price index. The blue line is for all industries, and it shows that wage inflation basically going sideways. But if you look at the composition, it's no big surprise that there are wage inflation is showing up exactly where you'd expect it, in this case in mining and construction. And also, if you do this on a state-by-state basis, it's also showing up exactly where you'd expect it, namely in Western Australia. The yellow line here is the rate of consumer price inflation, the headline measure. This is what the Reserve Bank targets. And last year, they raised rates right after we found out about 3% inflation in the March quarter, 4% inflation in the June quarter, and then 3.9% in the September quarter. After each of those readings, we raised rates. But the one that we got in early August followed a reading of 2.1% in inflation. What on earth were we doing raising rates when inflation was close to the bottom of the band? Well, of course, in order to understand that, in order to understand why we raised when inflation was effectively 2%, you have to go back to a year ago when we raised when inflation was 4%, and ask how we got to 4% inflation in the June quarter last year. And the answer is, there are 2 factors. Number 1, petrol, and number 2, bananas. Now, I've been standing up and talking about economies in one form or another for about 30 years. I started when I was 10. And I never thought I would seriously have to discuss the price of bananas. But that's why the line's yellow, incidentally. The Reserve Bank's not stupid. They know fruit happens. And so they essentially cut into, they do a bit of forensic science on the CPI, cut into it and isolate a couple of measures that they believe tell them about underlying inflation. And the red line is the average of those 2 measures. And so last year when they were raising rates, they saw underlying inflation, which had been bang in the middle of the range, if you like, creeping up and looking as if it was going to and through 3%. They raised rates 3 times. They probably wanted to raise rates again in February, but in late January we got a reading for the December quarter of underlying inflation of 0.5%. No smoking gun. Same thing happened in May, 0.5 again for the March quarter, no smoking gun. So they're sitting there thinking the election's getting closer, inflation pressures are building up, we really want to raise rates, we need an excuse, and in late July they got it. underlying inflation reading in the June quarter was 0.9%. They employ a bloke at the Reserve Bank to take that quarterly number and multiply it by 4 to get an annual rate. And when he did that, he got 3.6, and his mate checked it, and he got 3.62, and that was enough. That was enough for them, basically, to give us a rate rise that they believed was coming anyway. So nobody should have been surprised when they raised rates in early August. What I was surprised by was the hawkish rhetoric that came immediately after that, which said, we're going to do this again. Almost certainly. My suspicion is that the market turmoil since then has taken, the market turmoil and the chance of a weakening US has taken that next rate rise off the table, but it would not be unprecedented for Australia to be raising rates while the US is cutting. Just very briefly on oil, I guess Alison discussed this. I agree completely with her that that really most of that, the increase in the oil price. This is the most commonly quoted oil price in the world, so-called West Texas Intermediate, put in Australian dollars per barrel, which you don't usually see it in. First of all, it really is surprising, and it's partly because, as Alison said, this comes from the demand side. It really is surprising how little negative feedback effect the oil price rise has had on growth. And also how little positive feedback effect it has had on overall inflation. But my suspicion is that if it hasn't happened already, then I don't see why you'd be factoring that in strongly going forward. Just coming down to some of the nuts and bolts, if you like, of the economic outlook for Australia. The top line shows you building approvals. But right now, commencements in Australia are running around about 150,000 per year, and the general view is that the demographics in Australia sort of require about 170,000 per year. Two implications. First of all, it's probably going to go up, and secondly, this is the reason why you're getting talk about rental shortages, etc., and upward pressure on rents. But essentially, the dwelling sector presumably will add to growth in the year ahead. This shows you the share of GDP that's being spent on investment, and you'll see essentially that share has been rising mainly because of increased spending on buildings and structures, which would include a good deal of infrastructure and also would include a good deal of mining capital spending. The story so far, if you like, suggests that if we just forget about the US and the possibility of a recession for a minute, the forces of growth in Australia are still quite strong. The Australian economy hasn't had a recession, as you can see, in 16 years. There will be another one in Australia, I guarantee you that. And of course, we as a group need to know when that's going to happen. Unfortunately, there's no surefire way to tell, but I will give you one possible signal of the next recession in Australia. When you pick up the Financial Review and you read a story on the front page which says that the Australian economists are in agreement that the economy is headed for a soft landing, that could be a tell. To the long term, the consensus forecasters also put their minds together from time to time and forecast growth over the next 10 years. And Australia actually is expected to grow faster than any other developed country in the world on average over the next 10 years. So clearly not a bad place to be overweight. But the more interesting growth stories are still to the north. These, as I said, are the consensus forecasts for the developed countries, but if you just go to Asia, and these are the consensus forecasts for growth over the next 10 years in Asia. Before I put this up, you should have known who was number one and you should have known who was number two. I don't think the China story is going to be more important than India for a long, long time yet. First of all, it's bigger now and it's going to grow faster, although 20 years from now, the Indian growth story, I think, could well be at least as important or maybe more important than China. It's going to come about essentially because of the demographics of those two countries. 20 years from now, India will still have quite strong labour force growth and China will not. It's as simple as that. Provided that the US avoids recession, what we've been through in the last month is not the end of the bull market rally for the past 4.5 years.
I just want to get some clarity upon what is the global economic outlook. Is it one of a soft landing? Is it one of a risk of a hard landing? And what do we really think is going to happen in the US? And what is the housing market telling us? I'm happy to hear from both speakers on that.
Would you like to make them first? Yeah, I guess I wasn't very clear. Hedging pertains to your bets as well as to your foreign exchange exposure. I think the way to think about the world is that a soft landing is certainly attainable. But the risk here is that you could see the US move into recession. What I tried to suggest with the presentation I took you through was that the key indicators for that really are US employment growth. I know everybody says, well, that's a lagging indicator, but the central bank does need to think about the fundamentals, and income growth is the key to whether the US moves through into recession or weathers the financial market volatility. So I think a soft landing is possible, and I think that's, that is an important message.
I'd agree with that. First of all, it's important to understand where we've come from, essentially. It's no accident, for example, that that equity markets have done so well for the past 4.5 years, because throughout that period of time, the world economy has grown above trend, and you have to go back, 30 or 40 years to find the last time we had such a sustained period of above trend world economic growth. The current consensus forecast for growth both this year and next is continued strong growth, even with a US slowdown. But the consensus forecast says, you may recall that when I put up my chart which had the red line on there, the consensus forecast says that's about done. It's not going to get any worse. The US is going to stabilise somewhere just south of 2% growth and then turn around and go back up. Of course, there are always risks, and what is the risk, if you like, of a recession in the US? Alan Greenspan earlier this year, at about the time of the Shanghai market collapse, put the risk of a recession in the US this year at about 1/3. And I remember thinking at the time that seemed about right. A couple of months later, he repeated that forecast. And I wondered why he was repeating it then, and then I realised old men often repeat themselves. Old men often repeat themselves, the answer to your question is it all comes down, in my view, to the US. Now, having said that, Alison made this point also, and you look at Australian growth accelerating while the US is slowing. You look at Chinese growth forecasts have only gone one way for both this year and next, and there is a bit of decoupling going on. So the rest of the world, I think, can withstand a US recession a bit better than it has in the past, but I don't think it can withstand it completely. So it all comes down to the US. And let me give you another of these, possibly frightening statistics, if you like. The US publishes its unemployment rate monthly, as do we. If you take just run a 3-month moving average through their unemployment rate, and you observe something quite remarkable, and that is that when the unemployment rate goes up, it either goes up by 0.3 or less, and that's just a soft landing, which is where we are now, or it goes up by 1.5% or more. There are no instances in recorded history where it's gone up by 0.3 and hasn't subsequently gone up by a whole 1.5. So basically the switch between soft landing and recession is a pretty definite one.